How do gift tax, estate tax, and GST Tax Connect? Imagine passing on your wealth and wondering how taxes might affect what your loved ones receive. These taxes are part of a system designed to make sure the government gets its fair share when wealth is transferred. Let's break down how they work together and why they matter for estate planning. Gift tax is a tax on money or property you give to someone else during your lifetime. If you give more than the annual exclusion amount, which is currently $16,000 per person each year, you might need to pay gift tax. The good news is that the total amount you can give tax-free over your lifetime is called the unified exemption, which is set at $12 million. If you give more than the annual exclusion, that excess counts against your lifetime exemption. The gift tax rate can go up to 40% on amounts over the exemption. Estate tax is a tax on what you leave behind after you pass away. It includes the value of everything you own at death, plus any gifts you made during your lifetime that used up your exemption. The estate tax also has a 40% maximum rate. If you used part of your exemption during your life, the remaining amount shelters your estate from taxes. For example, if you gave away $2 million during your lifetime, only the rest of your exemption applies to your estate. Generation skipping transfer tax is a special tax that applies when you transfer wealth directly to grandchildren or other people more than one generation below you. It stops people from avoiding estate and gift taxes by skipping the immediate next generation. The GST tax has its own exemption, which is usually equal to the gift and estate exemption, and it also can be taxed at up to 40%. All three taxes are connected through the unified exemption. When you make gifts during your lifetime, they reduce the exemption available at your death. This means you can plan your gifts carefully to lower your estate tax bill. The generation skipping transfer tax adds another layer, making sure wealth passed directly to grandchildren or beyond is taxed appropriately. In estate planning, understanding these taxes helps you decide how much to gift now and how to structure your estate. Using the annual gift exclusion allows you to give smaller amounts tax-free each year. Combining this with your lifetime exemption can help you pass on more wealth without paying extra taxes. When planning for grandchildren or other distant relatives, you might set up trusts that allocate your GST exemption to avoid or reduce the GST tax. Trusts like crummy trusts are popular tools to make gifts qualify for the annual exclusion and lower estate taxes. Knowing how these taxes connect helps you keep more of your wealth within your family and less in taxes. It's all about strategic planning, balancing gifts, estate transfers, and generation skipping transfers to maximize what you leave behind. So, these three taxes work together to regulate and tax the transfer of wealth during life and after death. They share exemptions and rules that prevent people from avoiding taxes by gifting or skipping generations. Proper estate planning involves understanding these connections to make the most of your assets and ensure your wishes are carried out efficiently.